So I have a secret I would love to share with you guys, and it makes me concerned. What I see, and I'll just start off with what the secret is. It may or may not be a secret. I don't believe I've mentioned it here on this channel, but on weekends I wait tables at a restaurant. It's a tourist location. I don't do it for money. I'm a full-time dad, single dad, no help, have the kids all week, and mainly do it to, get out the house, some social interaction, making YouTube videos all day, watching a 1-year-old and a 4-year-old will do something wicked to your mental capacity. Your mental health definitely starts to suffer after a while. So that's the main reason I do it, to really get out the house. But I gotta tell you, it's concerning what I see. And I've worked here for a long time. Man, I don't even know where to start. It's so bad, you wouldn't even believe it, right? And this is a tourist location, right? This is people that are coming from all over the world to this area, and business has slowed down like 50% in 6 months, right? And I see it very much as a bellwether to the economy, but an early signal, right? What I mean by that is, let's say the data that we're starting to get now is like what I seen 6 months ago at this job, where things just started to slow down. And I think it's very much a leading indicator, or a leading indicator for me, lagging indicator for the markets. Basically, things are so bad that is going to get reflected in the data. I can only imagine if a successful restaurant like the one I work at, that I'm actually going to today, is doing so bad. I can only imagine how other businesses are doing, how other businesses are feeling, and their traffic, their profitability, all of that, in real time on the ground, related to consumer spending behaviors. There is a sharp revolt against higher prices and the willingness to spend money at this point. So in other words, basically what I'm saying, if this is correct, I think the data in the economy is going to start reflecting that. Over the next coming months, the data could get way worse for retail sales, personal spending, consumption behavior, which is over 70% of the economy. Now, a lot of guys on Wall Street, they're not going to have this inside perspective that I do, especially, working at this specific restaurant for many years, 6-7 years now. I don't work there as much now, obviously, just on the weekends, but that's the busy time. It's even worse during weekdays. The restaurant is losing money during weekdays. It's barely staying open because of the weekend. And again, the pace of deterioration in the consumer that is going to this restaurant, and the amount that they are spending at this restaurant, has dramatically gotten worse in the last 6 months. That's where I kind of struggle with my odds of a recession. I currently think a recession is 60, 65, 70% likely, partly because of what I'm seeing on the ground. And I think there is a very much lagged effect, where I'm seeing this stuff in real time, and it's taking months for that to actually look like it's being reflected in the data. So over the next 6 months, from what I can see right now, because I think the data is lagged by about 6 months, 6 months from now, I think we're going to see in the data what I'm seeing today. Basically what I'm saying. And it's not good. And it's not going to look good. Now, I think this has gotten to a bigger focus in recent weeks after the higher than expected unemployment rate caused the markets to get a little concerned. I mean, we just had initial jobless claims that came out a couple of days ago, 7,000 lower than expected, a seemingly worthless piece of data during any other normal time in the economy or in the markets that caused the best day in over a year for the S&P. What do you think's going to happen if retail sales come out bad on Wednesday? Worse than expected, which looks like it's probably going to happen. If I were to guess, we're probably going to come in with a weak number there, just judging off of what I'm seeing out in the economy in real time. People are broke. People don't have money. That's the bottom line. Inflation has eaten away the purchasing power of everyone, right? They just don't have the money to go out and spend frivolously like they did before. What do you think's going to happen though? It's gonna be rough for markets, and if it's not this month, it's gonna be in the coming months. And I don't think Wall Street's gonna get over this growth concern for a long time. I mean, I think this will ultimately end in a larger crash for markets. Now, we're going to take a look at some perspectives from Bank of America, from Peter Burskin with BCA Research, and what they're calling for. But I really just wanted to kind of tell you guys, I guess, this little secret and what I'm seeing. It just seems like the data is very lagged behind what is actually happening in real time. Okay. And it's not good. It's not for the better. And again, this restaurant is in a tourist location. It's in a wealthy area relative to my area of Michigan. I can only imagine how other restaurants are doing that do not have this flow of traffic from around the world. I mean, people come to this town to spend money, and it's still not good. With that said, you can definitely see tourism is down overall. There's not as many crowds as there was in years prior around this time. It's the busiest time of the year for the restaurant, and it's not good at all. I honestly, I think this winter is going to be really bad for the economy. At least what I'm seeing, translating that into economic activity and consumer spending behaviors being 70% of the economy, I'm not that optimistic. Now, is there a chance that we ultimately avoid a recession? Of course, but I think the data is going to get worse between now and the golden path at the end of the tunnel, right? If the ultimate destination is recession or soft landing, I think there's going to be worse data before we get an answer to any of that, right? And that's what the markets are going to react to, is the data. They're not going to react to, a potential soft landing. They're going to react to the data, right? And that's what's concerning over the next 6 months or so. I don't know what the next 6 months are going to do. Again, I think there's about a 6-month lag effect from what I'm seeing on the ground each weekend and what the data is actually reporting. Because again, 6 months ago is when things really started to slow down, and you're just now seeing that slowdown starting to be reflected in the data. That's kind of where that 6 months comes into play. Things have gotten really, really bad. Call it last year, 2 years ago, especially 2022, 2023. We would have lines out the door all night trying to get into this restaurant. I haven't seen a line at the door in 6 months, right? That's why I can definitively say 2022 we were not in a recession. People were spending money like crazy. That was really an inventory recession that caused 2 negative quarters of GDP growth. I don't think you've actually seen that recession yet. And I gotta say, what I'm seeing is alarming. Now, Peter Burson with BCA Research says stocks to crash 30% as the U.S. enters recession next year. And with the lagged effects that I'm seeing, I think that's probably an accurate timeline. I think over the next 6 months, it's going to become obvious that we are indeed heading into a recession. You know, my mom doesn't know a lot about, she also works at the restaurant, by the way. Another reason why I'm there, just to spend more time with her. She doesn't know anything really about economic activity, data, stocks, any of that. But she did live through 2008 and was heavily affected because of that. And she even thinks we're in a recession. She don't even know what recession means, right? She doesn't know it's 2 quarters of negative GDP growth. But what you're seeing on the ground looks like 2008 to her. Now, that doesn't mean 2008 is going to actually happen. There can be strong areas of the economy, weak areas of the economy. But to say a soft landing is likely at this point, I think it's just a fool's error, okay? Now, BCA Research says, quote, the events of the past few weeks should give investors a taste of what is to come, according to Montreal-based BCA Research. BCA sees the S&P 500 collapsing about 30% to 3,750 sometime next year as the U.S. enters a recession, driving down the yield on the 10-year Treasury note to 3%. By contrast, the lowest S&P 500 target among Wall Street strategists regularly surveyed by CNBC is JP Morgan's at 4,200, which is still an over 20% crash from here. It says, global equities have been hit by a 1-2 punch, BCA analyst led by chief global strategist Peter Burson wrote in a report released Thursday. The first punch was a jab in the form of rising skepticism over the bullish AI narrative. The second was an uppercut in the form of rising concerns over global growth. These first emerged in Europe and China and then spread to the US following a surprise jump in the unemployment rate. Although BCA expects stocks to stabilize in the near term, the medium-term direction is to the downside. We continue to expect the US to enter a recession in late 2024 or early 2025, the researcher said. You also have Michael Hardinet that says, quote, we remain in the sell the first cut camp, leadership of AI and derivative plays, set to wallow in second half of 2024 until EPS gains are more visible. And look at this. This is the biggest bet on bonds that we have ever seen before. This is a $2.7 billion bet on TLT. It says Northwestern Mutual invested $2.7 billion worth in TLT during June in a bet that a recession is coming soon. That was the largest monthly inflow to TLT in history. And this article says from, this looks like Bloomberg, it says, investor behind record $2.7 billion bond bet says recession is near. That's a lot of capital to be betting on a recession. I mean, and then you have Warren Buffett, which I think is probably one of the biggest telltales of all, with him raising his cash almost 30% in the last quarter. This is a chart of the history of Berkshire Hathaway's cash positions, and you've never seen anything like this before. Never have you seen anything like this before. And I think this is one of the biggest kind of red flags from someone that is level-headed, someone that perhaps knows more information than we do, perhaps knows something bigger is coming. And I've been doing the same thing. I've raised my cash position hundreds of percent in the last quarter. Went from having little cash to having almost half of my portfolio in cash. Now, a lot of that was just hitting good trades and not, buying stocks with that, just keeping the money in cash. We had a lot of big wins with IWM puts, TLT calls, Coinbase puts, that freak out we seen on Monday that made those do very well. Some other trades as well. And I'm happy with that choice right now. I think markets can go a little bit higher in the near term. I do think potentially the 50-day moving average on the S&P is in play, which is about 542. That could be upside of almost $10 from here. But I don't think this is the bounce to new all-time highs. I don't think this is a durable rally that continues. Of course, could I be wrong? Yes. But there is way too many warning signs out there. Now, what does this mean for Tesla if you're invested in Tesla? Well, I think to some degree, again, this is a bifurcated market where parts of the markets are already priced for recession and parts are not. For an example, I think Tesla is much better priced for a recession than Apple, for an example. So who's going to do worse if recession actually comes about or greater recession fears come about? Theoretically, you would think Tesla would do worse, but it wouldn't surprise me if a lot of the selling is again concentrated in big tech, and you do see more or less a stabilization until we do go into that recession in your other areas that are better priced for a recession. A lot of people think tech is like recession immune, and it's not. Now, this could mean more downside for Tesla. Eventually, when we do go into the recession, there will be more downside for Tesla. And I think Tesla will go lower. But again, it's going to be one of those scenarios where investors wake up and say, hey, the worst is probably over. Rates are now low, whether they're 0% or maybe closer to 2% or 1%. And that's going to cause a very bullish, I think, multiple year, potentially decade-long rally for Tesla and really the markets broadly. I don't know where the S&P will ultimately end. I don't know where Tesla will end. I would be very surprised if you went under $100 per share. I think maybe in a panic scenario that could happen. I do think anywhere from 140 to 120 is probably where Tesla would bottom out in that scenario. So I think having cash on the sidelines makes a lot of sense. But there's also a chance that, in my opinion, 35% chance that there is no recession, that maybe what we're seeing in the consumer side of the economy is just temporary. Maybe it's not as bad as it looks like. Again, me personally, what it looks like, what it feels like. And maybe we just keep chugging along. Although I don't think that's the most likely outcome, it's a possible outcome. And that's why I think you want to have some exposure to Tesla. You want to have exposure to stocks, broadly speaking, but you do want to have as much cash as possible. Either way this thing goes, I think cash is king right now. And again, a lot of people are not going to like this video. A lot of people are not going to agree with this video. This is a very non-consensus video where a lot of people are not under this view that things are worse out there than we actually think. But that's why it's an important video, because it's one of those warning videos to say things might not be as good as we think. Things might get worse from here. And how do you profit from it? Well, cash is king. Cash is how you profit from it. And if you have 2-3 months before we go into a larger crash, having that cash is going to be critical in making your fortune during this what could be recession, larger growth scare, whatever you want to call it. So let me know what you think about this down below in the comment section. Hit the like button, subscribe to the channel if you have not done so already. Again, let me know how your jobs are going. Are things slowing down? What industry are you in? Let us know those details down below in the comment section. You guys have a fantastic rest of your day. If you guys want to come trade with us live in real time, check out that link down below in the description of this video. We will be trading this market pretty aggressively in the weeks to come and hedging the portfolios and hopefully making a lot of money in the process. So if you guys want to come join us, that link is down below in the description. Enjoy your weekend though. That's most important, and I will see you in the next one.